Welcome to Money, 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 the first episode of 2017, and here is wishing all of you a very, very happy new year. Well, a lot is changing in the world of finance as this year kicks off. The raging debate about the economic fallout of demonetization, a sharp drop in lending rates announced by some of the biggest banks of the country over the weekend itself, and of course, the never-ending volatility in the stock market. Well, all of this has a direct bearing on your finances and on your wealth. So what's the New Year checklist that you must keep in mind? What are those investment mantras that will perhaps ensure that you multiply your wealth this year? Well, Kartik Jhaveri as well as Gaurav Mashruwala join me on the show today to tell us just that. Gentlemen, thank you so much for joining in, and I'll start by wishing you both a very happy 2017. So, some opening thoughts perhaps. Gaurav, let me ask you, do you have a good feeling as this year starts off? Is it going to be a money?
Absolutely.
Is it going to be a money-making year?
Of course it is going to be. It's always a money-making year, as long as you stick to discipline and whatever. But yes, it will be a good year, because whatever difficult things had to happen has happened. Also, now we have to look at the entire economy in a way where there is more money in the system. So instead of comparing with past data, it has to be start afresh and then start from here. So of course it's going to be much stronger economy, because now we have hopefully lesser parallel economy and more positive economy.
Kartik, are you feeling good?
Yes, absolutely. I mean, what a year it has been, right? I mean, we saw all the unexpected things. We saw Brexit happening. We saw Trump winning. We saw demonetization happening. There's a hell of a lot of things that have happened. But having said all this, yes, I agree. I mean, there's a lot of money in the system. So we should see a fabulous year. See, automatically money in the system, interest rates going down, profitability improving, debt funds doing better for investors, equity funds likely to do better in times to come. So all of that, you know, is like one after the other. The events are all sort of seemingly in a sort of a sequence, and this sequence will play out. As soon as the sequence plays out, we'll see a lot of prosperity probably coming down in 17, and if not 17, surely in 18.
Well, I guess there's always money to be made, but you just need to know where that money is being made and where you need to be. We will talk about a lot of that, but first up, let's get in the CNBC TV 18 team to help us make sense of really what lies perhaps in store in 2017. Now, 2016 wasn't the best year for the stock market, if you're looking at the index, at least the Nifty or the Sensex, but there were pockets of outperformance. As always, Nigel is here to break it down for us, the good, the bad and the ugly of the year gone by.
Well, that's right. The Indian indices, they made a late dash, in fact, towards the end of December, and that's why for the year, at least, we're trading with a positive bias. The Sensex ended the year with a 2% gain. The Nifty was a relative outperformer. It ended with a 3% gain because the Nifty bank really outperformed, and the Nifty, remember, has a higher proportion of banking stocks. So that's why we did see that the Nifty outperformed the Sensex. But let's take a look at some of those other Indian indices then. The Farmer Index as well as the IT Index. Defensives, they were clean bold, while the metal as well as the oil and gas space did very well in the past year or so. But when you compare India, you compare it with the other emerging markets. The Brazilian and the Russian index, they were on fire. They beat us by a mile. But at least we were relative outperformers in comparison to the Chinese index. That was down by more than 10% for the year. Moving to the US markets and the mother markets, they did very, very well in 2016 because they give you returns of around 8 to around 14%. And even the frontline European indices, they give you returns between 3 to around 13%. So clearly the European markets as well doing quite well. But as we wind up then, let's really focus on the big star. That's the Nikkei. Yet another year, it managed to end in the positive terrain. Remember, halfway through the year, in fact, they were down close to around 25%. So it rallied close to 28% from the lows that we saw in 2016. And that winds up a good 5-year winning streak for the Japanese Nikkei.
All right, Nigel, thanks so much for putting that in perspective. Now, the question is, will 2017 be a better year for the equity market? Nimesh Shah joins in with a roundup of what brokerages are saying.
Thanks for that. So we've looked at some of the finest minds for their outlook for 2017. I'll start with Rhythm Desai first. He believes that the markets are attractively valued and poised for a double-digit growth in FY17. In fact, at Morgan Stanley, they have an expectation of 15% returns next year. However, as far as growth is concerned, it's going to see a U-shaped recovery, albeit hit by demonetization, at least in the near term. As far as sectors are concerned, they are less bullish on defensives and they continue to bet on the rate sensitive. For Morgan Stanley, the base case Sensex target for FY17 is going to be close to 30,000. So that's the view from Morgan Stanley. Similar is the view from JP Morgan as well. Bharat Iyer feels, and they expect earnings to be close to 16% for FY17 and close to 28% for FY18. They believe they see a better pickup in terms of both rural and urban demand, and which is why they're betting on some of the rural plays as well. As far as macro is concerned, they expect RBI to cut rate by 25 to 30 basis 25 to 50 basis points over the next 6 to 9 months, and within sectors they are betting on the private banks. Similar came from Bank of America Merrill Lynch as well. So Sanjay Mukim has put out a note saying Indian equities can match the returns of bond markets in 17. The key triggers that they'll be watching out for are low rates, strong domestic flows. They have a Sensex target of close to 29,000 for year end. Within sectors, they prefer banks, they prefer rural plays, the likes of two-wheelers and tractors, and they prefer large caps. Interestingly, they don't see much value in the mid caps because most of the stocks are looking expensive to Bank of America Merrill Lynch. The last but not the least was Citibank. They feel that the second half of CY17 look much better in terms of improvement in earnings. The key triggers that they'll be watching out for is the progress on GST, how far the earnings turn around, which is likely in the second half of this year. In the model portfolio, they've made some changes. They've slightly reduced the weightage on financials on back of valuations. They've added Hero MotoCorp within the auto pack that they like, and they've trimmed their underweight on IT, but they still remain negative on IT. They trimmed their underweight on IT after a big underperformance last year. Net, if you look at aggregate, most of the brokerages feel that the returns on equities will match the kind of earnings growth which is likely to be second half of CY17, which means that the returns for Indian equities could be back-ended and not front-ended, at least in next year. Back to you.
All right, Nimesh, many thanks for that. And now let's come to the biggest headline, particularly if you're interested in either buying a home or have a home loan as of now, because we've seen some big announcements on the 1st of January itself. Of course, the Prime Minister giving a huge push to affordable housing. And then, of course, some of the biggest banks, starting with State Bank of India, announcing big cuts in their lending rates. So is the rest of the year going to offer more of this? Lata is joining in with her take. Lata.
Actually, 2017 is starting off as the best year for home buyers. State Bank and a whole host of other banks following State Bank have cut rates rather aggressively. It's a 0.5 percentage point cut over and above the about 0.5% that they have cut over the past 2 years. So at 8.65, the rate for a home loan has never been as low. For the last 6 years or so. The last time we had such a low rate was perhaps 2008. The important point is this is also the time that house prices are falling because of the vanishing of black money and the acute distress of land or real estate companies. Therefore, for a home buyer, this is a very good time, but watch out for the fine print. There are fixed and floating rates, and one has to take a judicious mix. Will rates fall further this year? It looks a little unlikely because banks are flush with cash now. If anything, people, when they start withdraw their savings and current accounts, banks may actually find it difficult to even stick to the current 8.65. Things could move up to 8.7 or so. So better to lock in at this point in time. When it comes to Government of India rates or the Reserve Bank's repo rate, it doesn't look like there will be too much by way of rate cuts. There may be space for one. I say not too much space because Donald Trump as president is expected to make the dollar very strong. Funds are expected to get attracted to the United States because of the growth-oriented policies, and therefore the rupee will be under pressure. And it's quite likely that the Reserve Bank may not see too much room. And crude prices, with the freeze in output getting underway, that will have a slightly inflationary impact, so not too much of rate cuts from the Reserve Bank. There'll be one perhaps after the budget, maybe one more, and that can take the 10-year bond maybe to 6.25. So expect at the most a 20 basis point fall in yields, which means a gain of 1 rupee on a bond, about a couple of rupees on a bond. Not much gains to be had there.
All right, Tata, thanks so much for that. And finally, 2016 wasn't such a bad year for the precious yellow metal. Gold actually managed to rise about 8%, outperforming the stock market if you're judging it by the Nifty or the Sensex. So what about 2017? Would it make sense to have some gold? Well, here's what the industry seems to be saying. Manisha has the details.
Well, thank you so much for that. A bit of a rewind first. And after 3 years of constant declines, gold prices have given you positive returns this time around. Actually, at one point in time, we were up by nearly 30% as well. But we are closing the year with nearly 9% of gains in the global terms. In the Indian markets, because of the rupee depreciation as well, the gold prices have given you 11% returns in the rupee terms. If you invested in the gold ETF, then that perhaps gave you a 12% return. That hasn't played at all when it comes to the gold and jewelry companies. Something like a Titan has given you a negative return of 7%, and that is because of demonetization, the kind of seizures and raids that happened into jewelry companies, and also because the year started quite on the weaker note because of the central excise duty. Remember, there were protests and it was a shutdown for the longest time when it comes to the jewelry companies. So gold in that form hasn't given you returns at all, negative as we spoke about. But when you talk about the global commodity funds or the gold funds, that has given you a startling reward of around 45% as well, because the gold mining companies have done even better than the gold prices themselves. 2017, well, most people expect that this is going to be yet another year of uncertainty when it comes to geopolitics, when it comes to financial markets as well, and that in turn actually might work positive for the gold prices. So there are varied views. People do expect that you might see a very strong support around $1,100 per ounce on the lower side, and on the higher side, $1,300, $1,375 are the kind of levels that you actually might see in case of gold. A couple of concerning points, of course, are the US Fed rate hike. 3 of them, if that happens, then there is a definite pressure coming in for gold. The US dollar trading at a 14-year high already has put pressure onto the prices. But then again, there are a couple of elections coming in Europe that can be supportive. Crude prices have been volatile. That has led to global inflation, and that has been a catalyst where you could see gold prices buying as well. So nearly 7 to 12% of gains is what the markets are anticipating for the gold prices to come into 2017 as well. So it still is a hold and buy when it comes to that commodity.
All right. Thank you so much, Manisha, and of course, all the rest of you. We'll take a break on that note. On the other side, we kickstart our conversation with the guests. Where should you be putting your money? What are those hygiene elements you must keep in mind as you look at 2017? Back in a moment.